As the market tries to find its footing, AiRWA Inc., trading under the ticker YYAI, is currently sitting at $2.65 per share, experiencing a sharp intraday drop of 4.33%. That's a decline of 12 cents on the day, and it's been a volatile session. The stock opened at $2.72, briefly touched the previous day's close of $2.77, and has since fallen to a new 52-week low of $2.49 before this slight bounce. Right now, looking at this ticker tells you almost nothing about the real story. Many investors will see that 52-week range, from this new low of $2.49 all the way to $316.50, and their eyes will widen. The immediate thought is that this is a lottery ticket, a fallen giant that could reclaim its former glory with a 100x return. But the reality is that the 52-week high is a ghost, an apparition from a completely different capital structure. The real immediate story here isn't one of a comeback, it's one of corporate survival. The most critical piece of information for anyone watching YYAI is this. Just 2 days ago, on October 27th, the company executed a 1-for-50 reverse stock split. This action, which consolidated every 50 shares an investor held into a single new share, was not a move of strength. It was a mandatory maneuver to get the share price back above the $1 minimum bid requirement to prevent being delisted from the Nasdaq. This context changes everything. The stock wasn't trading at $300 and fell to $265. It was trading at mere pennies, and the split artificially multiplied its price by 50. That $316.50 high is a pre-split adjusted relic that is functionally meaningless for new investors. The expectation of a simple buy the dip and ride back to the highs is completely disconnected from the reality of a nanocap company with a market valuation of only $49 million that is fighting to keep its stock exchange listing. The retail chatter, which we can see on forums and comment sections, is a mix of extreme confusion and blind hope. We see comments from last week talking about the stock at 7 cents, correctly predicting the split would bring the price to around $4. We also see the classic battle cry of a meme stock and a massive short squeeze, with investors pointing to a high short float. This is the narrative that many are trading. They see a low-priced stock, they hear about AI, and they see short squeeze potential. They are trading the expectation. The reality, however, is far more complex and significantly more precarious. The volume today, at over 1.15 million shares, is already substantial, especially when you consider the new post-split float is only around 19 million shares. That's a significant percentage of the entire company's available stock changing hands, indicating a high-stakes battle between those buying into the squeeze narrative and those selling into the post-split liquidity. So who is AiRWA Inc.? This is where the story gets even more convoluted. The expectation is that a company with AI in its name and a ticker like YYAI is a focused cutting-edge technology firm. The reality is that this company appears to have a severe identity crisis, funded by a stream of buzzword-heavy press releases. Until very recently, the company was known as Connexa Sports Technologies. Its own filings and descriptions paint a picture of a business pulled in at least 3 different directions. One description states it operates artificial intelligence software for online matchmaking and dating in Hong Kong, the US, and the UK. A separate description claims it designs and develops portable ball launchers and practice equipment for sports. And the most recent and perhaps most speculative pivot is its activity in the Web3 space. The company claims to be driving innovation in digital finance through something called the AiRWA exchange, which will focus on the tokenization of real-world assets, or RWAs, particularly tokenized U.S. stocks. This is a classic nanocap strategy. Throw as many hot-button concepts at the wall as possible: AI, sports tech, Web3, crypto, RWA, and hope that one of them attracts enough capital to fund operations. We've seen press releases announcing a $500 million deal with a firm called JuCoin, a content agreement with TikTok for the Middle East and North Africa market, and the receipt of $30 million in Solana tokens. This news flow is designed to create a perception of massive scale and rapid progress. But the company's $49 million market cap and negative earnings per share tell us the market is deeply skeptical that any of this will translate into sustainable profit. Now let's talk about the element that has so many speculators interested, the short seller position. This is without a doubt the most fascinating and dangerous part of the YYAI story. The expectation from many retail traders is that the shorts are trapped and a massive squeeze is imminent. The reality is that the position held by short sellers is extraordinarily aggressive, deeply confident, and incredibly expensive for them to maintain. According to data from Fintel, the short interest is 1.82 million shares, which is about 12.7% of the float. While other services have reported wildly higher numbers, even 12.7% is a very significant bearish bet against a company this small. But the short interest percentage isn't even the main headline. The real story is the borrow fee rate. This is the interest rate that short sellers must pay to borrow the shares they need to sell short. As of yesterday, that rate hit an astronomical 277.3%. Let me repeat that. 277%. This is not a typo. This means it is prohibitively expensive to be short this stock. Short sellers are paying a fortune in annualized interest just to hold their bearish positions, indicating both a massive demand to short the stock and a very limited supply of shares available to borrow. This creates a powder keg. On one hand, the shorts are clearly paying this unbelievable premium because they are supremely confident that the stock's true value is far lower, likely heading towards zero. They are betting that the 1-for-50 reverse split is a death spiral event, which will be followed by more shareholder dilution as the company sells new, higher-priced shares to raise cash. They are betting that the hodgepodge business model of AI dating, sports equipment, and a crypto exchange is a house of cards. On the other hand, this extreme cost to borrow is exactly what squeeze-focused traders look for. If the stock price begins to rise or even just holds its ground, the cost to maintain these short positions becomes agonizing. Shorts could be forced to buy to cover their positions simply to stop the bleeding from the interest payments, which in turn drives the stock price higher, creating the squeeze. What's your take on that 277% borrow fee? Is that a sign that short sellers are trapped, or a sign they are supremely confident this stock is going to zero? The technical days to cover metric, which measures how long shorts would take to cover their positions based on average volume, is around 1.56 days. That's a significant amount of time, implying that if a squeeze did ignite, the shorts could not all get out at once. Furthermore, the off-exchange short volume ratio is high, at over 57%, meaning a majority of short selling is happening in dark pools and not on the public lit exchange. So who is the smart money in all this? The expectation might be that with so much potential, institutions are quietly loading up. The reality is the exact opposite. Institutional ownership in YYAI is almost non-existent. We're talking about only 15 institutions in total holding a position, and the amounts are trivial. Vanguard and Geode Capital, for example, hold tiny positions, but these are almost certainly just part of their passive, total market index funds, which are forced to buy every stock. In fact, recent filings show that active managers like HRT Financial and JP Morgan have completely exited their positions. There are no major actively managed funds placing a bet on this company's future. The smart money is either shorting it at 277% interest or is staying millions of miles away. This leaves the stock almost entirely in the hands of retail traders who are, as we've seen, completely divided. They are fighting each other, and they are fighting the shorts. This brings us to the future outlook. The expectation is a 100x return. The reality is a fight for survival. The primary risk here is simple. The reverse split was just a temporary fix. The company is burning cash as indicated by its negative earnings. The next logical step is a public offering, selling new shares into the market. This dilution would flood the market with supply, absorb any retail buying pressure, and likely send the price crashing back down, trapping everyone who bought after the split. The company's multifaceted business plan is a massive risk. A company that tries to do everything at once often accomplishes nothing. On the flip side, is there any catalyst? The only bull case rests on two possibilities. First, that one of these lottery ticket press releases is actually real, that the AiRWA exchange, for instance, actually gains traction and generates real revenue, or that the AI matchmaking patent is genuinely valuable. Second, the bull case rests entirely on market mechanics, that the 12.7% short interest and the 277% borrow fee will be enough to trigger a short squeeze regardless of the company's fundamentals. This makes YYAI not an investment but a pure high-stakes gamble on technical market pressure. Comment below with the one business model you think AiRWA should actually focus on: AI dating, sports equipment, or their new RWA exchange. Or should they just pick one? In the end,